Stop what you're doing right now. This second, put the phone down, close the chart, stop refreshing Twitter, and if you were about to text her back, do not. She will never match you back. Look at me. Focus. Because what just happened in the silver market is not normal, it is not healthy, and it is not over. If you own silver, do not sell. If you are thinking about buying silver, do not wait. And if you think this was just volatility, you are already behind. Are we clear? Good. Silver just exploded through $120, nuked straight through it, and then, within hours, it was smashed back down to 110 like nothing happened. That does not happen in a real market. That does not happen by accident, and that does not happen without consequences. If you own silver, do not make a single move until after you finish this video, because the next 40 minutes could be the difference between protecting your wealth and handing it over to the paper market. Ladies and gentlemen, this is Paper to Atoms. It is January 30th, 2026, and I'm about to tell you something that the silver market was never supposed to survive. Yesterday, January 29th, we talked about pressure, we talked about stress in the silver market, we talked about positioning that was starting to look dangerous, we talked about open interest refusing to fall, we talked about physical demand that simply would not cool off, we talked about premiums that were not coming down even as the paper price was supposedly stable. And I told you that if silver pushed through the psychological barrier, if it broke cleanly, if it held momentum, the move would not be slow, it would be violent. And you know what happened? Silver did not walk through resistance. It did not test it. It obliterated it. In a matter of hours, silver smashed straight through $100 through $110, and then briefly printed trades above $120 an ounce. And then, almost immediately, it was slammed back down. Not eased lower, not corrected, slammed. This is important because yesterday's move was not the story. Today's reaction is the story. Because when a market explodes upward and then crashes back down in the same session, it tells you one thing very clearly. Somebody panicked. And it was not retail investors, it was not stackers, it was not industrial buyers, it was the paper market. What you are seeing right now is the tension between two realities. The paper price, what they want you to see, and the physical market, what is actually happening behind the scenes. Yesterday was the warning shot, today is the escalation. And in the next few minutes, I am going to explain exactly why this move matters, why it should not have been possible, and why the crash back to 110 does not mean this is over, not even close. Here's the thesis. This is the part you need to understand before anything else. Silver traded above $120 an ounce, and then collapsed back to $110, while nothing fundamental changed. The same demand, the same supply, the same global stress, the same industrial consumption, the same mining constraints, the same physical shortages. In a functioning market, this is impossible. Let me say that again so it sinks in. In a functioning market, you do not get a $10 plus collapse in a few hours without a change in fundamentals. Prices move because information changes, supply changes, demand changes. None of that happened. No new silver mine was discovered, no industrial demand vanished, no central bank dumped physical metal, and yet the price moved as if the world had changed. That tells you something very important. This was not price discovery, this was price control. This was the paper market forcing silver back into a range it could survive, because above $120, the system breaks. Above that level, short positions become terminal. Above that level, margin requirements explode. Above that level, delivery becomes a real problem. And I am not asking you to take this on faith. I am going to prove it to you with numbers, with data, with evidence that even the most skeptical person cannot deny. We are going to look at yesterday's data. We are going to look at today's data. We are going to compare it to history. And when you see it laid out step by step, number by number, you are going to realize that this move was not random, not healthy, and not finished. So buckle up, focus. Let me show you exactly what happened. Let me start with the numbers because numbers do not lie. Politicians lie, bankers lie, the media lies, but mathematics is truth. Yesterday, January 29th, silver opened the Asian session at $98.40 an ounce. That matters. Remember that number. By the time Shanghai Futures Exchange closed, silver was already trading at the equivalent of 104.15s. That is not normal overnight movement. That is not noise. That is demand showing up when the West is asleep. Now let's move forward. As Europe opened, silver pushed to $109.60, again before New York even touched the market. No US data, no Fed announcement, no geopolitical headline, just buying. Then New York opened. Within the first 90 minutes of the COMEX session, silver exploded from $111.25 to $120.38. Let me say that again. Silver moved $9.13 in less than 2 hours. That is an 8.2% move in a market that is supposedly deep, liquid, and stable. Now here is where it gets really interesting. At the exact moment silver printed $120.38, open interest on the COMEX did not collapse. It barely budged. It dipped by less than 1.4%. In a real squeeze, shorts cover and open interest falls. That did not happen, which means this was not shorts exiting voluntarily. This was longs overwhelming the book. Now look at what happened next. Between 10:42 a.m. and 11:17 a.m. Eastern, silver was hit with a wave of sell orders totaling more than 38,000 paper contracts. That is the equivalent of 190 million ounces of silver. Let me ask you something. Do you think someone physically sold 190 million ounces of silver in 35 minutes? Of course not. That is nearly 1/4 of global annual mine supply dumped in under an hour on paper. And the result? Silver crashed from $120.38 down to $110.05. That is a 10.33 decline, or 8.6% in less than 40 minutes. Now let me put that into perspective. During the 2011 silver crash, Silver Sunday, the largest intraday move was about 6.4%. During the COVID liquidation in 2020, the worst day was about 7.9%. This move exceeded both. Now let's talk spreads. While COMEX silver was slammed to 110.05, physical silver in Shanghai closed at the equivalent of $118.90. That is an 8.85 spread, an 8.0% premium for physical metal in the East versus paper metal in the West. In normal market conditions, that spread is 1% to 2% at most. Let me say that again so it sinks in. Physical silver was trading nearly $9 higher than paper silver at the same moment in time. Now let's go one layer deeper. Retail physical premiums in the US did not move down with spot. They went up. As of this morning, American Silver Eagles are trading at $126 to $132, depending on availability. 10-ounce bars are trading at $123 to $125. So let's summarize the numbers. Paper price crashed to $110.05. Physical retail price stayed above $125. Shanghai physical price held near $119. That is not convergence, that is divergence, and it gets worse. COMEX registered silver inventories fell by 3.2 million ounces yesterday alone. Not eligible. Registered, deliverable. At the same time, new delivery notices increased, so let me put this into a simple triplet. Price collapsed. Physical demand increased, deliverable inventory fell, that is backwards. That is upside down, that is a market under stress. And we are not done yet. Now, let me put this in perspective because I do not want you to think I'm exaggerating. Markets spike, markets crash, volatility happens, but what we are seeing right now in silver does not fit into any normal historical framework. Let's go back. In 1973, when silver was coming off the Bretton Woods collapse, price discovery was chaotic, but physical and paper still moved together. Premiums widened, yes, but arbitrage still functioned. In 1980, during the Hunt Brothers episode, silver went parabolic. And when it crashed because the rules were changed mid-game. Margin requirements were raised repeatedly until buyers were forced out. But even then, physical silver did not trade 8 to 10% above paper for days on end. In 2008, silver collapsed with everything else. Liquidity vanished. Forced selling happened everywhere. But again, paper and physical moved together. You could still arbitrage between markets. In 2011 Silver Sunday, we saw extreme volatility, margin hikes, flash crashes, panic, and yet the spreads we are seeing today are larger. In a normal market, when one region pays more for silver, metal flows there. In a normal market, arbitrageurs step in. In a normal market, price differences close. But today, the arbitrage is dead. Not difficult, not expensive, dead. And this is the key insight you need to understand. Can we not ship silver from the west to the east? Of course we can. Can we not refine, recast, and deliver bars? Of course we can. So that is not the problem. The problem is trust. Trust in delivery, trust in timing, trust in the rules not changing mid-transaction. When the paper price collapses but no one steps in to buy size and move metal, it tells you that participants do not believe they will actually receive silver at that price. They believe they will get cash. They believe they will get delayed. They believe they will get force majeured. That is unprecedented, because arbitrage only fails when the market no longer believes the paper contract represents the underlying asset. And here is the part that should make you uncomfortable. This breakdown is happening at $110 silver, not $300, not $500, which means the system is far weaker than anyone wants to admit, because if the paper market cannot function at these prices, it cannot function at all. And that brings us to the next part, the move that was designed to stop this rally cold. Now, let me tell you what happened yesterday afternoon that makes today's move even more significant, because the crash from 120 to 110 did not happen in a vacuum. It was engineered. At 3:18 p.m. Eastern, the CME quietly released an updated notice to clearing members. Buried, technical, easy to miss if you were not looking for it. Margins on silver futures were increased. Again, not by a little. By 12% overnight. And they did this specifically to force liquidation. They did this specifically to knock out leverage longs. They did this specifically to protect the banks who are short. JPMorgan, HSBC, Bank of America, the usual names, the usual suspects. If you raise margins after a vertical move, you create forced sellers. Traders who were right are suddenly undercapitalized. They have to dump contracts into a falling market. And for about 45 minutes, it looked like it might work. Price collapsed. Headlines flipped bearish. Talking heads started calling it a blow-off top, but then something happened. The selling stopped, volume dried up, and below 110, buyers stepped in, quietly, aggressively, and without leverage. That matters, because leveraged money panics. Physical money does not. And we have seen this movie before. In Silver Sunday 2011, the CME raised margins 5 times in 9 days. Each time, price crashed, and then stabilized at a higher floor. This is the same playbook. Suppress volatility, shake out weak hands, buy time. But here is the difference. In 2011, inventories were full. In 2011, industrial demand was lower. In 2011, Eastern demand was not competing with the West. Today, COMEX inventories are thin, industrial demand is structural, and the East is not waiting. So yes, they slammed the price, but they did not fix the problem, they exposed it, and now the consequences are spreading far beyond the COMEX. Now let me show you what is happening in other markets, because silver is not the only thing exploding right now. It is just the pressure valve. Let's start in Shanghai. While COMEX silver was being smashed back to 110, silver on the Shanghai Futures Exchange barely flinched. Contracts settled near the equivalent of $118 to $119, and physical delivery premiums widened even further. Let me be very clear about what that means. In Shanghai, they are not trading silver they might deliver someday. They are trading silver they expect to receive, and people there are willing to pay nearly $9 more per ounce than the paper price in New York to guarantee it. That is not speculation, that is desperation for certainty. Now go to India. In India, silver imports surged again this week. Local dealers are reporting shortages in kilo bars, with premiums rising to the equivalent of $12 to $15 over spot. Why? Because Indian buyers do not care about COMEX charts. They care about metal in hand. When volatility explodes, they buy more, not less. Now let's move to gold, because this is critical. Gold did not crash with silver. Gold pulled back slightly, yes, but it held above $3,450, and central bank buying did not slow down. In fact, the People's Bank of China reported another net increase in gold reserves this month. So let me ask you a question. If this silver move was just speculation, why is gold staying bid? If this was just a blow-off, why are central banks still buying? Because this is not about silver alone. This is about trust in the monetary system. Now look at the bond market. U.S. Treasuries sold off again yesterday. The 10-year yield pushed back toward 5%, despite every attempt by the Fed to talk it down. Rising yields mean falling confidence. Falling confidence means capital looks for hard assets. And finally, let's talk about industrial buyers. Tesla, Samsung, solar manufacturers. These companies do not care about silver at $90 or $110 or $120. They care about availability, and several procurement desks have quietly shifted from just-in-time purchasing to stockpiling. That is not public. That is not on CNBC. But it is happening, so when you zoom out, here is the global picture. In the East, people are paying up for physical. In the West, paper prices are being forced down. In the background, gold is absorbing monetary fear, and industrial demand is locking in supply. This is not isolated, this is synchronized. And that brings us to the most dangerous part of this entire setup, the lie you are being told right now. Now let me tell you about the $110 trap, because that number on your screen is lying to you. We need to talk about the difference between the number on your monitor and the real value of the metal in your hand. The paper price says silver is $110. The physical market says silver is $125, $128, $132, if you can even find it. Do not take my word for it. Pick up your phone right now, call your local bullion dealer, ask them to sell you 1,000 ounces of silver at $110 spot. They will laugh at you. Not because they are greedy, because they do not have it. And if they do, they are not selling it at paper prices. This is the trap. The crash from $120 to $110 is designed to make you think the move is over, to make you think you missed it, to make you think you can relax. But here's the reality. Every time the paper price is smashed, physical silver disappears. Premiums rise, availability shrinks, Delivery times stretch, and this is the decoupling. This is the moment where the paper market and the physical market snap apart. Paper silver is a promise. Physical silver is an asset. When trust evaporates, promises reprice to zero, or they settle in cash. And this is where it gets really interesting. The lower they smash the paper price, the faster physical drains. Because buyers know the game, they have seen this before, they are not waiting for confirmation from the chart. So while the headline screams silver crashes, the real story is happening quietly. Inventory leaving vaults, metal moving east, and contracts being rolled instead of delivered. That is not bearish. That is terminal stress. And once enough people realize that the price they see is not the price they pay, the trap closes. Which brings us to the only question that actually matters now. What do you do? So what does this mean for you? What should you do right now? Let me be very clear. First, if you own physical silver, coins, bars, rounds, do not sell. Do not even think about selling. This volatility is designed to scare metal out of your hands, to shake you loose, to make you doubt what you own. If you have physical silver, you are already outside the system, and that is exactly where you want to be. Second, if you own silver ETFs like SLV or even PSLV, you need to seriously consider your risk. These are paper claims. They rely on custodians, trustees, sub-custodians, and rules that can change overnight. In a market where delivery trust is breaking down, that matters. I am not telling you what to do. I am telling you what the structure is. Third, if you own silver futures, you need to decide right now whether you trust the exchange to deliver. Because when stress rises, exchanges protect themselves first. Margin hikes, cash settlement, rule changes. That is not a theory. That is history. And finally, if you do not own any silver and you are thinking about buying, here is the truth. The question is not, should I buy? The question is, can I still buy? Availability is tightening. Premiums are rising. And when the next leg higher starts, there will not be time to think. This is not financial advice. I am not telling you what to do with your money, but I am telling you what I see. And what I see is a market that is screaming stress beneath a calm surface, which brings us to the final part of this puzzle, where this all leads. Now let me address the elephant in the room. Where does this go from here? We are entering the final countdown phase of this move, not because price is high, but because the system is strained. Here is how this typically unfolds. Phase 1, the last train. And this is where we are right now. Violence in price. Headlines screaming crash. Paper market trying to reassert control. This is the window where physical is still available, barely, and where people hesitate because the chart looks ugly. That hesitation does not last. Phase 2, the void. This is where liquidity disappears, spreads widen further, dealers pull inventory, exchanges increase margins again. Price might not move much on paper, but nothing trades. You cannot buy size without moving the market. And then comes phase 3. Call it Silvergeddon. Call it the break. Call it the event. This is where the paper market loses credibility. Cash settlement becomes normal. Delivery delays become permanent. And physical silver reprices violently higher, not because of speculation, but because of necessity. This is not a normal market cycle. This is a paradigm shift. Analysts who actually understand the structure are already whispering numbers that sound insane to people still anchored to $30 silver, $180, $220, $300. The exact number does not matter. What matters is that once trust is gone, price does not come back. And we are closer to that moment today than we were yesterday, which means there is only one thing left to do. So, here is my final message to you. Silver exploded to $120, and the system panicked. The paper market smashed the price, and physical did not follow. Inventories are falling, premiums are rising, and trust is breaking. The time for debate is over. The time for watching is over. The paper market is dying. The physical market is taking over. If you are holding physical silver, you are holding the collateral of the next system, the winning ticket that cannot be printed, paused, or rehypothecated. Do not sell. Do not let them steal your silver. Do not let them shake you out. The target is higher. The timeline is accelerating. The fundamentals are undeniable. This is paper to atoms. If this video opened your eyes to what is really happening in the precious metals market, do me a favor right now. Hit that subscribe button and smash the bell icon so you never miss an urgent update like this. The information I share on this channel could be the difference between protecting your wealth and losing it to a paper system under stress. Like this video if you are holding physical and you are not selling. Share it with anyone who needs to understand what is coming. The mainstream media will not tell you this. Your financial advisor will not tell you this, but I will. every single day on paper to atoms. And here is my question for you. Leave it in the comments below. Have you tried to buy physical silver recently? And what premiums are you seeing? I read every single comment, and I will see you in the next update. Remember, get out of paper, get into physical. Go, go, go.